Credit Suisse releasing its market outlook for 2019, and it's a fairly bullish call. The bank forecast the S&P hitting 3,350 points by December 2019, a more than 15% upside from its current level. Joining us now to discuss what could push the index to that level, Jonathan Golub, Chief U.S. Equity Strategist at Credit Suisse. Good afternoon to you, Jonathan. Great for joining us. Have you got a Busyism for the market? No, I'm joking. Jonathan, the 2019 forecast for the S&P is a fairly significant upside from here. And running through till late next year, a lot of people would expect the market to have topped out by then.
Yeah, I mean, I think the underlying story here is that the run that we've had in the market all year, I mean, right now we're up a little shy of 8.5%. If you add dividends in, we're about 10% year to date. Is that I think this is going to be running through the rest of last year. And if you look at what the story was in 2018, where it looks like we're going to have something like 21% earnings growth, which is just massive, and multiples contracted. And next year, what you're looking at is that earnings are going to be in line with long-term history, 7 to 8%. But I think that you're going to get some of the multiple contraction that you've had move away from you. I think you're going to get it back.
I'm having a little deja vu because I think you came out as one of the earliest, most bullish forecasters on Wall Street ahead of this year, right? You had a 3,000 target for the S&P 500. Didn't quite get there.
Yeah, and one of the things, Sarah, that difference being a strategist as opposed to a trader is as you're moving towards the end of the year, and also when your calls kind of in line with what you'd hoped it would be. We're almost like smack in line with where that 3,000 target would be for this year. You want to move the goalposts further away and get people to think a little bit longer term. Otherwise, people are wondering, are you going to be a penny ahead or penny below? And I want to get the discussion on.
That's why you're starting in September.
Starting in September. Well, yeah, and what people typically do is they do it like right before the end of the year. And I think it's important to extend the horizon and start a tiny bit earlier.
Jonathan, when we look at August, or in fact just year-to-date generally, the outperformance of the US versus the rest of the world, both developed and emerging, has been stark. As you continue your bullishness for the US, do you expect the rest of the world to play a part in that bullishness, or is this extraordinary divergence going to continue?
The top global strategist happens to be my partner over in London, and Andrew Garthwaite. And so Andrew, I think, is more bullish on emerging markets, less bullish on Europe. I know he is. When I look at the U.S. market specifically, what you have here that you don't have anyplace else is this massive engine in technology. And even though you have some tech in emerging markets in Asia, they're really more, for the most part, the manufacturing side of technology. So folks who make the Intel chip or folks who make the Apple phone, as opposed to the intellectual capital behind that. And that really, it really changes the whole way that the U.S. market operates compared to everyone else. But if you ask the question broadly, do I think this divergence on economics and earnings are likely to continue? The answer is yes.
And all of this despite whatever happens with the midterm elections, the trade war, I mean, some big unresolved issues.
Yeah, we put this in this notes there that we put out this morning. We highlight this laundry list of worries. There's this expression, the market, climbs a wall of worry. People are concerned about the yield curve inverting and the Fed tightening and trade wars and midterm elections and inflation picking up. The question is, are any of these really going to derail it's really two things, the business cycle. Are we going to be looking at a recession in 2019? And if the answer is no, you want to continue to be long stocks. And is it in some way going to squeeze the underlying profit engine? And I think 7 to 8% profit growth next year is a reasonably conservative number.
3,350.
3,350 in the market. That's 1% a month for the next 16 months.